Okay, so today we're diving into Forex portfolio diversification. Like, imagine you're building a house. You wouldn't just use one type of material, right?
Right.
You need a strong foundation, sturdy walls, a weatherproof roof. Diversifying your Forex portfolio is kind of like that.
Yeah.
Building a structure that can withstand different market conditions.
That's a really good analogy
Yeah.
because in Forex, putting all your eggs in one basket, or in this case, one currency pair, can be kind of risky.
Exactly. And today we're using excerpts from Fund Your FX's guide to help us build that resilient portfolio. Now, for anyone new to this whole Forex thing, it's short for foreign exchange, and it's all about buying and selling currencies to profit from those price swings we see.
And those fluctuations can be unpredictable sometimes. That's where diversification is so important. It's about spreading your risk across different currency pairs, so you're not relying on just one to do well.
So not putting all our hopes on one currency to suddenly take off. Got it. But this guide made a point that I found really interesting. They compared it to investing in stocks.
Yeah, they said, think about it this way. You wouldn't put all your money into a single company's stock,
Yeah.
right?
Okay.
It's the same idea with currencies. You don't want your entire financial well-being tied to one company or one currency pair.
So instead of going all in, we're spreading our investment strategically. That makes sense. But here's the thing. If the Forex market is all about these currencies interacting, how do we even know where to start?
Well, it can feel overwhelming at first, for sure. I think a good starting point is understanding the different types of currency pairs we have, what we call the majors, minors, and exotics.
Okay, so it's like sorting our ingredients before we start cooking. Break down these currency categories for us.
Absolutely. The majors are the most traded pairs in the world. Think euro against the US dollar, UR/USD, US dollar against the Japanese yen, USD JPY. Those are the big players. They're highly liquid, meaning it's easy to buy and sell them, which is great if you're just starting out.
So our most reliable ingredients, what about the minors?
Minors are still important, just less heavily traded. Think something like the euro against the British pound, URGBP. They can offer more specialized opportunities, but can also be a bit riskier.
All right, a bit more niche, but still worth considering. Which brings us to the exotics. I'm already intrigued.
Exotics involve currencies from emerging economies paired with a major currency. For example, the US dollar against the Turkish lira, USD/TRY. These can be tempting because they might offer higher potential returns, but they also come with significantly higher risk.
Gotcha. So we're not diving into the exotics head first, but knowing about these different types is just the first step, right? It's how these currencies interact that really matters for diversification.
You're absolutely right. And this is where understanding correlation is crucial. It's all about how different currency pairs move in relation to each other.
So we're not just looking at individual players, but their relationships with each other.
Exactly. And there are two main types of correlation, positive and negative. Positive correlation means the pairs tend to move in the same direction.
Like they're dancing to the same beat.
Exactly. For example, UUR/USD and GBP/USD often move similarly because they both have the US dollar in them.
Okay, so what happens when they move in opposite directions?
That's negative correlation. It's
Yeah.
like one partner stepping forward while the other steps back. A classic example is EUR/USD and USD/CHF. That's the US dollar against the Swiss francs. Often when the US dollar strengthens against the euro, it weakens against the Swiss franc.
So even though they're different pairs, there's still a connection there.
Exactly. And recognizing these correlations is so important when you're building a diversified Forex portfolio. You don't want to end up with a portfolio full of positively correlated pairs where if one goes down, they all go down.
Because that would be like building our house entirely out of glass. Looks nice, but one crack and the whole thing could shatter.
Exactly. We want to diversify. We need to mix those materials, mix our currency pairs to create a portfolio that is much more resilient.
So we've got the basics down, majors, minors, exotics, and we're starting to understand those correlations. But now for the fun part, right? Building the diversified portfolio. What are the key strategies our listeners should be thinking about?
Well, Fund Your FX actually outlines 7 key strategies, and the first one they mention is looking beyond those major pairs.
Okay, so even though they're called majors, we shouldn't limit ourselves.
Exactly. Remember the minors and exotics we talked about? They definitely have a role to play. But we can take this a step further. Think about incorporating assets from other markets entirely.
Okay, now we're branching out. What kind of assets are we talking about?
Commodities are a great example. Gold, for example, often moves inversely to the US dollar. When the dollar weakens, investors often flock to gold as a safe haven, which pushes its value up.
So if part of my portfolio is in gold and the dollar takes a hit, those losses might be balanced out by the gains in gold.
Exactly. It's all about that balance. And it's not just gold either. Other commodities like oil, natural gas, agricultural products,
Yeah.
they all have interesting correlations with currencies.
So we're diversifying across currency types and asset
Mm.
classes. I like it. What else does this guide recommend?
Strategy number 2 is about your trading approach. Don't just stick with one trading style. You got to mix it up. Incorporate short-term and long-term strategies.
So instead of just quick trades, we think about some long-term holds as well.
Precisely. Short-term can be great for those quick market moves, but long-term strategies can provide more stability, and you might benefit from those bigger market trends.
It's like having a sprinter and a marathon runner on our team, each with their own strengths. Okay, what's next on our list?
Strategy number 3 is thinking globally. Don't limit your portfolio to just one region. Spread those investments around.
So if one region is having a tough time economically, other parts of our portfolio can maybe pick up the slack.
You got it. Like, let's say you're heavily invested in European currencies, and the Eurozone goes into recession. But you also have investments in North America or Asia. That could help buffer your portfolio against those region-specific risks.
Spreading that risk geographically, a global safety net. I love it. Okay, what's next on this diversification checklist?
Number 4 is all about time frames.
So not just what we invest in, but also how long we hold those investments.
Exactly. Don't get stuck just looking at daily charts, for example. Think about incorporating different time frames into your strategy. Weekly or monthly charts for those longer-term trends. And even hourly charts, or shorter, if you're comfortable with more active trading.
It's like having a telescope and a microscope.
Exactly.
Each gives us a different perspective. What other strategies did this guide highlight?
Well, even with a diversified portfolio and a solid strategy, risk management is still key.
Makes sense. Even with a diversified portfolio, we still need some protection. What kind of strategies are we talking about here?
One of the most useful tools is a stop-loss order.
Right, I've heard of those. But how do they work exactly?
So basically, it's an instruction you give your broker. If a currency pair drops to a certain price, your broker automatically sells it. That way you limit your potential losses.
So it's like a safety net. If the trade goes against us, we automatically get out to minimize those losses.
Exactly. It's especially important in Forex because it can be so volatile. For example, let's say you buy EUR/USD at 1.1000, and you set a stop-loss order at 1.0950. So if EUR/USD falls to 1.0950, your broker automatically sells, and you limit your potential loss to 50 pips.
That's really helpful. What else should we be thinking about when it comes to risk management?
One of the biggest mistakes traders make, especially new traders, is risking too much capital on a single trade.
So even with a diversified portfolio, we still need to be careful about how much we're risking on each individual trade?
Absolutely. A good rule of thumb is to risk no more than 1–2% of your total capital on any one trade. That way, even if you have some losses, you won't wipe out your entire account.
That makes a lot of sense, protecting ourselves from those market swings. Okay, so we've covered a lot, diversifying across currency types and asset classes, mixing our trading strategies and timeframes, thinking globally, and always managing risk. What else does this Fund Your FX guide highlight?
Well, they saved what I think is the most important point for last. And it's not about a specific asset or trading technique. It's about you, the trader.
Okay, I like where this is going.
The 7th strategy is all about continuous learning. The Forex market is constantly changing, and you have to change with it.
So we can't just set it and forget it. We need to stay informed and adapt.
Exactly. Keep up with economic news, understand global events, always be learning.
Be a student of the market. So we've covered so much ground, from the different types of currencies to some pretty advanced strategies. But I think the big question is, can we ever truly eliminate risk in Forex trading just by diversifying?
I think that's what everyone wants to know, right? Honestly, if anyone ever tells you they have a risk-free way to trade Forex, I'd be very skeptical. The truth is, every investment has some risk. And that's especially true in Forex with all its moving parts.
So if we can't get rid of risk entirely, then what's the point of diversifying?
It's not about erasing risk. It's about managing it. Diversification is less about avoiding the storm and more about building a ship that can handle it.
I like that. Building a portfolio that can weather those market ups and downs.
Exactly. And that's what I really appreciated about Fund Your FX's guide. They emphasize that diversification is about more than just picking the right currencies. It's about understanding your own risk tolerance and what you're hoping to achieve.
So there's no one right way to do it.
Exactly. It all depends on your individual circumstances. Are you someone who's comfortable with a lot of risk? Or do you prefer to play it safe? Your diversification strategy should reflect that.
That makes a lot of sense. For someone who's just starting out, maybe feeling a bit overwhelmed by all of this, what would you say is the most important thing to remember?
I would say start with yourself. Before you even open a trading account, think about your financial goals. What are you hoping to achieve by trading Forex? How much risk are you really comfortable with? Once you have a good understanding of those things, then you can start exploring different strategies that make sense for you.
So it's about creating a plan that's tailored to our own individual needs and goals.
Exactly.
This has been a fantastic conversation, really insightful.
It has.
So to wrap things up, we've explored how to diversify your Forex portfolio, we've looked at different strategies, and we've talked about the importance of risk management. We hope you found this deep dive helpful and that you feel ready to start building your own Forex strategy. Until next time, happy trading, everyone.